Welcome to Pressure Points. Our topic is Nvidia earnings. And as of this recording, which is about 20 minutes after the earnings call ended, shares are up about 0.5%. When the numbers initially came out, they're up 3.5%. They entered the earnings call up 2.5%, just kind of drifted downwards towards the call. There wasn't like one specific event that caused a sell off. We'll get to that in a minute, but I just wanted to start with some context about what the stock is doing. I want to break this episode down into three pieces, talk about the stock, talk about the fundamentals, and then talk about the broader read through to AI. As far as the stock is concerned, these results were undeniably impressive. They exceeded high expectations, and we see this muted results. It reminds me a little bit about Apple's previous quarter when they just blew through the numbers and the stock. I think it actually traded down on what was just an impressive outlook. And I think it just speaks to this continued concern about what the sustainability is. But I want to put some specific numbers around what happened. So revenue growth in the just reported January quarter was up about 73%. The street was looking for 64% revenue growth in the April quarter. Their guidance, if you take the high end of their revenue range, which is they'll probably exceed the high end of the revenue range, was for 79%. So accelerating revenue. That normally is a recipe for a stock to do well. In particular, that the whisper number was for about 70% growth. So they guided higher than what the whisper number was, these optimistic whisper numbers. But yet here we are, the stock being basically flattish in after hours. And again, it speaks to this concern, which ultimately is about 2027. And the last question on the call came from a Goldman analyst that kind of got to this about the sustainability of growth. But really, next year is now the pivotal point, which investors are going to be queuing in on. The current street estimates expect 28% growth for calendar 27 over calendar 26. My guess is by tomorrow morning, they'll be looking for 35% growth. And I bet effectively in the end, they'll deliver probably 50% growth or higher. But still, that's a long ways away, and it's still hard for investors to get comfortable. We've seen that for several quarters. And so as I kind of think about the stock, this company is going to continue to do well. I think that there is upside to this stock. We do own it, but I think that it's going to have relatively less upside versus some other AI companies, in part because of the size, and this wall of worry just doesn't seem to be going away for investors. So that's the stock. Let's shift gears and talk about fundamentals. I previewed them with that guidance, which for April, which was just impressive. Again, 79%. It's probably going to end up being over 80% growth from the just reported 73% in the January quarter. The data center business, of course, is what is leading the charge. No surprises there. That's basically 90% of revenue. They did mention that the top customers, hyperscalers, account for about 50% of business, and we're highlighting that non-hyperscalers are becoming an increasing amount, and those are growing faster, which should give some comfort to investors on the fundamental side that the kind of the breadth of this build out is expanding. My sense is that if you take the hyperscalers and then you throw in the Anthropics, the XAI, SpaceX, and OpenAI on top of that, Oracle, you're probably looking, those top 8 are probably 70% of revenue. So it's still a big number. So even though they highlighted it, doesn't really change the broader topic around this customer concentration, which also speaks to the revenue sustainability. Second is in terms of China. They basically said that they could start to see some China revenue, but it's a little bit unpredictable. And I think even if they had more bullish comments about China, it really wouldn't make a difference for kind of how the fundamentals play out here, because more China revenue, yes, that would be nice, but just given what we've been through over the past year on China, I suspect that investors will kind of back out most of that China, that benefit, and think that it's kind of hit or miss on a quarter to quarter basis. Third is in terms of the production piece, the availability of inventory. CFO Crest mentioned that they should have enough inventory to meet demand for the full year for calendar 26, which surprised me. And the stock really kind of had a neutral to negative reaction when she mentioned that. There's this odd dynamic as when you talk about being in supply demand equilibrium effectively, it does remove this kind of this hopeful, wishful dynamic where if you beat your numbers and you weren't at supply demand equilibrium, you can kind of dream up how big the numbers could have been or would be in a future quarter. But if you're operating at equilibrium, then that kind of takes away the numbers that you see are what you get. And so there is a little bit of a psychological headwind to being, as bizarre as that sounds, to being in equilibrium. They are not in equilibrium on their gaming business. That's 8% of revenue. They said they're going to be supply constrained there. I don't think investors care that much about that, but they will be supply constrained there. The next topic is in terms of margins and profitability. And they talked about that as long as they deliver real value to customers with Rubin, which is going to be on track to ramp it in the back half of the year, they should have no problem at kind of maintaining those margins, which was, again, a really bullish comment that the stock really didn't react much to. The last piece, the last one I think was the most important question, was that Goldman question at the very end, which basically he outlined some previous comments the analyst did about what Jensen had said about how revenue can continue to accelerate. And previously Jensen had talked about the CapEx kind of this year being 700 billion-ish, but that could be much bigger in the future. And it was a couple minutes before the call ended, but Jensen took about 7 minutes answering the call. I would describe it as almost going into a manifesto, which was, I think, helpful. And it did pass the test, the sniff test for me in terms of how sustainable this company, that it can grow faster than longer than most people think. And essentially what he's saying is he built the kind of comparison between the way software and the world, the compute world was built before at 300 to 400 billion a year in kind of infrastructure. And now and that is, he referred to it as kind of like a DVD, something that's recorded. Software was built, it was recorded, it was static. And now we're moving to a world where AI is powering this, and this is real time. It is much more valuable because it's real time, it's dynamic, it's generative. And that his take is that that is infinitely more useful than something that is static, and that the CapEx and the need for compute around that is 1,000 times greater than what we saw in regular compute. Therefore, if you take 350 billion and multiply that by 1,000, you get a very big number. And so his case really comes down to is, do you believe that AI is in fact going to deliver the utility that it has? And I can attest that as even at Deepwater, as we've been using these agents and understanding what's happened in the past few months around OpenClaw and Claude Cowork, that there has been a meaningful step forward in the utility of this. And so his comments do pass the sniff test. I do believe that Nvidia is going to, the fundamentals are going to exceed expectations for many quarters to come. I don't know how much that is going to result in the stock moving meaningfully higher. And so I do believe it goes higher, but that kind of mixes all of those comments, kind of gives you the end result. Last piece, I mentioned we're going to talk about the stock, the fundamentals, and last about what's going on with the broader AI trade. And at the most basic level, what we're seeing here is things are moving so fast that I think people who don't use these tools, like really build with these tools, aren't grasping how fast things are moving and potentially how disruptive this is. What we can see is these results are a reflection of what we heard from the hyperscalers a few weeks ago, is that this meaningful increase, on average, they increased off of a high bar up 25% a few weeks ago for their CapEx outlook for calendar 26. And so what we're seeing at the highest level is that these companies that have a front row seat in terms of where this could go are telling us in multiple ways, whether it's through their CapEx guidance or Nvidia's results, which are closely, or Nvidia's guidance, which are closely tied together, that we are still early. And I left this call that feeling even better about us being earlier than what many believe in terms of this AI, the infrastructure build out, the impact to humanity. I think we're still in the second inning. That is both exciting and both concerning, whether you think about how that can, all the different ramifications that that can have. But at its most basic level, the most important part about tonight was really about what's going on, how early we are in AI. On behalf of Pressure Points, I'm Gene. Bye for now.